CMA exam support package, which has 367 MCQs and it consists of 30 essays. And the part 1 of your CMA exam consists of 6 sections. The first section is external financial reporting decision. The second is planning, budgeting and forecasting. The third section is performance management. The fourth section is cost management, and fifth section is internal control, and sixth one is technology and analytics. So let us start with section A, which is external financial reporting decisions, and the section that we are going to discuss today is financial statements, which has 35 MCQs. The topics that are related to financial statements are: we have objectives of financial reporting, we have the objectives, we have the balance sheet, income statement, a statement of changes in equity, a statement of cash flows, and the last topic is integrated reporting. So let us start with the 35 MCQs of financial statements. The financial statements included in the annual report to the shareholders are least useful to which one of the following? We have stockbrokers, bankers preparing to lend money, we have competing businesses, we have managers in charge of operating activities. So they are least useful. The external financial reports, they are least useful to internal users. And the internal users are, we have internal users like management is the internal users, board of directors is the internal users, and we have employees. They are the internal users within the organization. So let us classify these as internal users and external users. A stockbroker is external user. Bankers preparing to lend money are external users. Competing businesses are external users, and managers in charge of operating activities is the internal users within the organization. So they are least useful to the internal users because internal users uses management accounting, not the financial reports or the annual reports. They use management accounting. They are useful for stock brokers because they are the brokers, and they provide recommendation to their clients for investment and disinvestment. Bankers preparing to lend money, the financial or annual report are useful for bankers who prepare to lend money because they will conduct the analysis on which they are going to give you money or they are going to finance you. Competing businesses, the annual reports are useful for competing businesses because competing businesses can compare your financial statements with the industry average, with the industry competitors, with themselves. So they can compare your financial statements with others. So they also need for competing businesses. But managers in charge of operating activities, they are the internal users, and internal users uses management accounting. They are the least dependent on the financial reports. So that's why it's least useful to managers in charge of operating activities. Next, when a fixed asset is sold for less than the book value, which one of the following will decrease? Here a fixed asset is sold for less than the book value. When you sell an asset for less than the book value, what happened? Let us pass the journal entry and we'll understand what is going to happen. We will get, when a fixed asset is sold for less than the book value, you will get some cash. Accumulated depreciation related to the assets will get rid of that depreciation. There is a loss, we'll get a loss on sale, and there will be a fixed asset. For example, the fixed asset that was recorded was of $10,000, and there was a depreciation related to this asset was 3,000. So the net book value of this asset is 8,000. No, 7,000. So the net book value of the assets is 7,000 and we are selling this asset for $5,000, incurring a loss of 2,000. Because the net book value of the asset is 7,000 and we are selling at 5,000, incurring a loss of 2,000. Now let us see what happens. Cash is a current asset. So when we get cash of $5,000, the current asset will increase. If the current asset will increase, this means total current assets will increase. Current ratio is current assets by current liabilities. If the current assets are increasing, the current asset will increase here and it will lead to an increase in the current ratio. Net working capital is the difference between current assets minus current liabilities. If the current assets, here the current asset is increasing by $5,000, so it will increase, net working capital will increase, because net working capital is the difference between current assets and current liabilities. So what will increase? Total current assets will increase because current asset is increasing. Current ratio will increase because we calculate current ratio by current assets by current liabilities. If this is increasing, the current ratio will increase. Net working capital is the difference between current assets and current liabilities. So current asset is increasing, the net working capital will increase. But net profit will decrease because we are incurring a loss of 2,000. So it will decrease by 2,000. So net profit will decrease. So net profit is the correct option for the MCQ number 2. Next. On July 15, a company entered into a 3-month agreement to rent a machine the company needed to complete a special order. The machine would be delivered on August 1st. On July 15, a company entered into a 3-month agreement to rent a machine the company needed to complete a special order. The machine would be delivered. The machine is being delivered on August 1st. And the rental payments are due on the first day of each rental month. The effect of this event will have on the company's July 31st. So they are asking what will be the effect on July 31st financial statements would be. So here we have 3 dates. We have July 15, we have July 31st, when we have August 31st. July 15, there is no rental agreement. July 15, we have only a rental agreement of 3 months of rental agreement. And there is no financial transactions that are taking place on July 15. On July 31st, also it is the same thing, that no financial transaction or activity happens on July 31st. But the activity happens on August 31st. The machine is delivered on August 1st. The machine is delivered on August 1st and the payment and the rental payments are due on the first day of each rental month. So what happens? The activity starts on August 1st. So what will happen on July 15? There is only a rental agreement and there is no financial transaction. On July 31st also there is no financial transaction or activity. That's why it will result in no change in assets, no change in liabilities, or no change in income. Next. All of the following are limitations to the information provided on the statement of financial position. The statement of financial position is the balance sheet. So what are the limitations of balance sheet? Judgments and estimates used regarding the collectability, sellability and longevity of assets. This is one of the limitations of balance sheet, that we use certain estimates and judgments and that certain estimates and judgments can go wrong. Omission of items that are financial value to the business, such as worth of employees. This is also one of the limitations of balance sheet because financial statement presents quantitative information, that is the numbers, the quantitative information. The qualitative information is not reported in the financial statements. For example, here we have worth of employees. The another example can be given as that can be customer satisfaction or the brand image or the employee morale. So these are the things that are not reported in the financial statements. We only report the numbers, that is quantitative information is reported, qualitative information is not reported. Lack of current valuation for most assets and liabilities. We use historical concept. Many assets are recorded at historical prices, so that's why the current valuation of for most assets and liabilities is very difficult to find. So this is one of the limitations of balance sheet. Quality of earnings reported for the enterprise. This is done by the income statement. It has no relation to the balance sheet because it is the quality of earnings. Earnings is reported in income statement. So that's why this is the correct option. But B, C and D are the limitations of balance sheet. Limitations of balance sheet. Next. A statement of financial position provides basis for all of the following except here we have the limitations of balance sheet. Here we have the benefits of balance sheet. Let us see what are the benefits of balance sheet. The balance sheet helps to calculate the rates of return. Yes, the balance sheet helps us to calculate the rate of returns. The balance sheet helps in evaluating the capital structure. For example, what is your sources of finance and what is your actually the capital structure. For example, what is your debt percentage or what is your equity percentage. That is, it may be 30% debt or 70% equity. It also helps us to assess the liquidity and financial flexibility. Liquidity means you can calculate ratios like current ratio, you can calculate acid test ratio, you can calculate working capital ratio, you can calculate solvency ratio as well. So these are the benefits of balance sheet. A statement of financial position is the balance sheet. Above are the limitations of balance sheet, and these are the benefits of balance sheet. Determining profitability and assessing past performance. Determining profitability and assessing the past performance is done by the income statement. It has no relation to the balance sheet. So the benefits of balance sheet is computing rates of return, evaluating the capital structure, assessing liquidity and financial flexibility. The limitations of balance sheet are quality of earnings reported for the no. This is not the limitations of balance. This is reported by income statement. The limitations of balance sheet are judgment and estimates used regarding the collectibility, sellability, and longevity of assets. Omission of items that are of financial value to the business, such as worth of employees, customer satisfaction, and brand image. They are omitted. They are not reported. Lack of current valuation of most assets and liabilities because we use historical concept, and many assets are reported at historical prices. That's why you cannot find the current valuation of for most assets and liabilities. Next. An income statement could be used by an external investors. So an income statement can be used by external investors for all of the following purposes except two. Compare company results to those of competitors. Yes, the external investor can compare the company results to those of its competitors. They can do this. The external investor, they can assess the risk of the companies by achieving future profitability. Yes, they have the access to your financial reports, so they can assess the risk of the companies achieving future profitability. They can compare your financial statements with the competitors, with themselves, with others, with the industry average as well. They can predict the company's future revenues. Yes, they can predict the future revenues as well, but they can't do this one. Analyze the company's performance compared to the budget. Why they can't compare to the budget? Because budget is an internal document. Budget is an internal document, and here we are talking about external investor. So external investor will not have any access to our internal document, which is budget. So external investors cannot compare our company's performance to the budget. So that's why this is the correct option. Next, the financial statement that provides summary of firm's operation for a period of time. So the financial statement that provides a summary of firm's operation for a period of time is the income statement. The financial statements, like we have financial statements, we have income statement, we have a statement of financial position, that is balance sheet, we have a statement of shareholders equity, we have a statement of retained earnings. The income statement was summary of firm's revenue summary. Summary of firm's revenues, expenses, and net income or net loss over a specific period of time, such as month, quarter, or year. It helps evaluate company's profitability. It helps to evaluate the company's profitability and performance. The income statement consists of 4 elements and 2 types. So what are the 4 elements? The 4 elements are revenues, we have expenses, we have gains, and we have losses. So these are the 4 elements of income statement, and there are 2 types. We have single step method, and we have multiple step methods. So income statement is having 4 elements and 2 types. A statement of financial position, which is known as the balance sheet. It provides a snapshot. Of firm's financial position at a specific point of time. Income statement is over a period of time, but a statement of financial position, balance sheet, is a specific point in time, and the income statement is having 4 elements, but the balance sheet is having 3 elements. We have assets, this is the first element, liabilities is the second element, and shareholders equity is the third element, which can be denoted by assets is equal to liabilities plus equity. So equity, liabilities, and assets are the 3 elements of balance sheet. Now next we have a statement of shareholders equity. Presents changes in the equity section of a firm's balance sheet over a period of time. Income statement, a statement of shareholders equity, a statement of retained earnings, they are presented over a specific period or over a period of time. So what does it? This statement of shareholders equity provides stock issuance, dividends, retained earnings, additional paid-in capital. These all things are there in a statement of shareholders equity. A statement of retained earnings displays changes in firm's retained earnings over a specific period. It shows how net income, dividends, and prior retained earnings contribute to the current balance sheet of retained earnings. So this is the statement of retained earnings. So here the question is being asked for the financial statement that provides summary of firm's operation, that is income statement. Over a period of time is the income statement. It's not financial position, it's not shareholders equity, it's not retained earnings. It is the income statement. Next. Batam company had a balance of 100,000 in retained earnings at the beginning of the year. So the company is having 100,000 in retained earnings. So this is the opening balance in the retained earnings, and 125,000 at the end of the year. So this is the closing balance. Net income for the time period was 40,000. Net income is 40,000. By chance, the statement of financial position that dividends payable has decreased. So here, what happened? One account dividends payable had decreased by 5,000 throughout the year, despite the fact that both cash dividends and stock dividends were declared. So we are declaring two types of dividend. One is cash dividends and one is stock dividend were declared. The amount of the stock dividend amount is given. The stock dividend was 8,000. The amount of the stock dividend was 8,000. When preparing the statement of cash flows for the year, Bacham should show cash dividend paid for dividend hours. So every dividend is paid out of retained earning, and we have declared two types of dividends. We have declared a stock dividend, and we have declared the stock dividend, and we have declared the cash dividend. So let us open a account known as the retained earnings account, because every dividend is paid out of retained earnings. So we need to find out how much cash dividend is paid, because a stock dividend is given that we have the amount of stock dividend is 8,000, and the cash dividend is not given. How much cash dividends we have declared, it's not paid. First we need to find how much cash dividend we have declared. So that every dividend is declared out of the retained earnings. That's why we have to open an account of retained earnings. So the opening balance, the brought down balance of retained earning is 100,000. The carried down balance of retained earning, we have 125,000. During the year we have a net income of 40,000. So net income of 40,000 means the retained earning account will increase by the net income, that is 40,000. And we have declared two types of dividends. We have declared the cash dividend and we have declared the stock dividend. The amount of stock dividend is given, that is 8,000, and the cash dividend, we can find the cash dividend by simply addition of total debits and total credits. So the cash dividend comes to 7,000. So we have declared cash dividend of 7,000. Now they are asking for show cash paid for dividends. Declaration is not payment. We have we have called date of declaration. On the date of declaration, the entry that we are passing is retained earning account debit to dividends payable. And on the date of payment, we pass a journal entry, that is dividends payable account debit to cash. So it is the date of payment that we pay the dividend. It's not on the date of declaration. So here, what on the date of declaration? So they have declared both. What happens? Dividends plus throughout the year, despite the fact that both cash dividends and stock dividends were declared. They are declared. So on the date of declaration, we are not paying anything. Cash is not going out from our pocket. So we are just passing an entry. So we found that the cash dividend is 7,000. So let us find the how much cash dividend actually we have paid on the date of payment. That can be found out by dividends payable account. So let us open the dividends payable account. So this is dividends payable account. So the dividends payable account has decreased by 5,000. So what do you mean by that dividends payable account has decreased by 5,000? So this means that opening balance Opening balance of dividends payable minus closing balance of dividends payable is equal to 5,000. So any difference should lead to 5,000. So let us consider the difference of opening balance to be 20,000 and the closing balance to be 15,000, which gives us 5,000. So now let us plug these numbers in dividends payable account. So the brought down balance is 20,000. The carried down balance is 15,000. So we have declared a dividend. So cash dividend is being declared. So if the cash dividend is declared, so we will pass a general entry, that is 7,000 dividends payable and 7,000 retained earning is debited. So when dividends payable account is credited, means dividends payable account will increase by 7,000. So dividends payable account is increasing by 7,000. Now we will find how much we have paid, that is the cash dividends. So by taking the total debit and total credit, the cash dividend comes to 12,000. Cash dividends comes to 12,000. So the answer is 12,000. Next, all of the following are elements of the income statement except. The elements of income statement are, there are four elements of income statement. We have revenues, we have expenses, gains and losses. So expense is an element of income statement. Gains and losses are the element of income statement. Expense is an element of income statement. Revenue is an element of income statement. So these are the four elements of income statement. Four elements of income statement. Shareholders equity account is an element of balance sheet, not an element of income statement. So that's why this is the correct option. Next, the statement of shareholders equity shows A. The statement of shareholders equity account shows A. So let us move towards the account of various accounts, various statements and accounts. This is a statement of financial position balance sheet. This is a statement of changes in equity, and we have a statement of retained earnings. So this is being asked in the MCQ. So reconciliation of the beginning and ending balance of shareholders equity accounts. So the statement of changes in equity shows the beginning balance and the ending balance and the reconciliation. From the beginning balance to the ending balance. Reconciliation of the beginning and ending balance of the shareholders equity accounts. Listing of all shareholders equity accounts and their corresponding dollar amounts. Listing of all shareholders listing of all shareholders equity accounts and their corresponding dollar amount. This is a list of all shareholders accounts. It is shown by the balance sheet, the statement of financial position or the balance sheet. This is the listing of all shareholders equity accounts and their corresponding dollar amount. This is shown by balance sheet, and its reconciliation is shown by the statement of changes in equity, by the beginning balance and the ending balance. Now we have a statement of retained earnings. A statement of retained earnings is also the reconciliation, but It is only the reconciliation of retained earnings. What? It is the reconciliation of retained earnings. We have beginning balance of retained earning, that is, we have beginning balance of numbers, no, that is not important. We have the beginning balance of retained earning. We have certain adjustments. We add net income, we add dividends distributed, we get the ending balance of a statement of retained earnings. So this is the reconciliation of the beginning and ending balance in the retained earnings account. Only the retained earning account, the reconciliation of the retained earning accounts. Balance sheet is the listing of all shareholders equity accounts and their corresponding dollar amounts, and the reconciliation is shown by the statement of changes in equity. So let us proceed towards the MCQ now. Reconciliation of the beginning and ending balance in shareholders equity accounts is shown by the statement of shareholders equity. This is the correct option. Listing of all shareholders equity accounts and their corresponding dollar amount is shown by the balance sheet. This is a ridiculous response. Reconciliation of the beginning and ending balance of retained earnings account is shown by the statement of retained earnings. Next. Which one of the following items could be identified on the cash flow statement prepared using the indirect method? The payment of interest expense is an income statement item. It is not income statement item. It is not shown on the statement of cash flows. A change is unrealized holding gains of 50,000. This is not shown on a statement of cash flows. A settlement of lawsuit that was previously accrued. This is also not shown on the statement of cash flows. But depreciation is shown on the statement of cash flows. It's a non-cash item and that is shown on the statement of cash flows, and it is added to the net income. Net income plus depreciation expense. So that's why this is the correct option. Next, consider the following financial data for a company that is preparing its cash flow statement. We have amortization expense 150,000, cash dividend paid to common shareholder. Cash dividend paid to common shareholder, this is the financing outflow. Net income, and we have work in process inventory increase over the prior year, that is 300,000. Gain on sale of equipment is 50,000. Using the indirect method, cash flow from operating activities. So we need to find cash flow from operating activities. So let us, cash flow from operating activities is found, the starting point is found, if the starting point is to start with the net income, so we take net income, that is, so we have net income which is 1.5 million. Amortization expense is added to the net income. Amortization expense and depreciation expense is added to the net income. So we will add the amortization expense, that is plus amortization expense which is 150,000. Now we have inventory. This is cash dividends paid. Cash dividend paid is a financing activity. Cash dividend paid is a financing activity. It's not an operating activity. So cash dividend is financing activity. So we have started with net income. Work in process inventory increase over the year. Work in process inventory increase over the year. This means that we have bought some inventory and cash goes out from our pocket. So inventory, that is outflow. There is an outflow of 300,000. Gain on sale of equipment 50,000. Gain on sale of equipment is deducted from the net income because already we have considered the gain. So the gain on sale of equipment is deducted from the net income. So gain will be deducted, that is 50,000, and we get an amount of 1.3 million, which is 1.3 million. Next, Dividends paid. Dividends paid to company shareholders would be shown. Dividends paid to company shareholders would be shown on the statement of cash flows as. The statement of cash flows as financing activity, and that is cash flow from financing activities. All of the following are classification on the statement of cash flows except. So what are the classification of statement of cash flows? We have three classification. We have net cash flow from operating activities. This is the first. We have net cash provided by investing activities. This is the second classification. Net cash provided by financing activities. This is the third classification. So what do we have? Operating activities, yes. Investing activity, yes. Financing activity, yes. We don't have anything like equity activities except equity activities, which is the correct option. Next. The purchase of fixed asset should be accounted for on the statement of cash flows as. The purchase of fixed asset is an investing activity. Cash flow from investing activity, that is cash flow from investing activity, that is purchase of PP&E, is cash flow from investing activities. Purchase of fixed asset, investing activity. Next, a statement of cash flows prepared using indirect method would have cash activities listed in which or one of the following orders. We are listing cash flow as first is we are listing as net cash provided by operating activities. This is the first listing. The second listing is net cash provided by investing activity, and the third listing is that net cash provided by financing activities. We have three listing: operating, investing, and financing. So let us find operating, investing, and financing next. Kelly Company acquired land by assuming a mortgage for full acquisition cost. This transaction should be disclosed on the Kelly's statement of cash flow as N. So what is happening? Land is being purchased for what? Mortgage. Land is being purchased for mortgage, so there is no cash involved. No cash paid or no cash received. So there is no cash involved. So if there is no cash involved, that is non-cash financing and investing activity, because you are purchasing a land without the involvement of cash. Next, which one of the following should be classified as an operating activity on the statement of cash flows? So the classification of operating activity on the statement of cash flow. A decrease in accounts payable during the year. A decrease in accounts payable. So a decrease in accounts payable is shown on the statement of operating activities. Increase or decrease in accounts payable, increase or decrease in inventory, increase or decrease in accounts receivable, increase or decrease in trading securities, increase or decrease in wage payable. These are reported on the operating section of the statement of cash flows. Now, an increase, this is the correct option, an increase in cash resulting from the issuance of previously authorized common stock. Issuance of common stock is a financing activity. The purchase of additional equipment needed for current operation. Purchase of additional equipment needed for current operation is investing activity. The payment of cash dividend from money arising from current operation. Payment of cash dividend paid is a financing activity. Cash dividend paid is a financing activity, and cash dividend received is an operating activity. So difference between cash dividend paid and cash dividend received. Cash dividend received is operating activity. It comes under the operating section of the balance sheet, and dividends paid comes under the financing activity. Next, when using the statement of cash flows to evaluate company's continuing solvency, the most important factor to consider is the cash. Is the cash. So what they are asking, when using the statement of cash flows to evaluate company's continuing solvency, To evaluate the company's continuing solvency means the ability of the business to generate cash regularly. And we have three activities. We have operating activities, we have investing activities, and we have financing activities. Operating activities are repetitive, they are regular, and they are from primary operations. Net cash flow from investing activities, they are not regular, they are not repetitive. For example, purchase of property, plant and equipment, sale of fixed assets, purchase of available for sale securities, sale. So these are not regular activities, and cash flow from financing activities are also not regular. But net cash provided by operating activities, they are regular. They are from your continuing business. For example, increase decrease in trade securities, increase decrease in accounts receivable, increase decrease in inventory, accounts payable, wages payable. They are the primary operations. So that's why the most important section in the statement of cash flow is the operating activity. So they are asking for when using the statement of cash flows to evaluate the company's continuing solvency, the most important factor to consider is the cash inflow from operating activities. This is the most important section in the statement of cash flows. Most important section, the operating activities. Next, the most commonly used method for calculating and reporting the company's net cash flow from operating activities on its statement of cash flow is the indirect method. There are two methods from which we can prepare the statement of cash flows. So we have direct method, and the second method is indirect method. So we can prepare the statement of cash flows from direct method and indirect method. So let us understand what's the direct method and indirect method. So that can be understood by looking at the financial statements. So the statement of cash flow, this one is the indirect method, and here the statement of cash flow we have direct method. So the difference between direct method and indirect method is the operating section. This is the operating section of the statement of cash flows. So operating section, in indirect method, it starts with net income, and there are some adjustments, and the adjustments also related to the current assets and current liabilities. So this is the indirect method through which we can find the operating activities. The indirect method is that we take total cash inflows and we take total cash outflows and we get the operating section. So the difference between direct method and indirect method is only in the operating section of the balance sheet. Other section like investment activities or investing section or financing section remains same in indirect method as well as the direct method. So let us proceed to the MCQ, what they are asking for. The most commonly used method for calculating and reporting a company's net cash flow from operating activities on its statement of cash flow is the indirect method. This is the most commonly method used is the indirect method. Direct method is not commonly used. Next, the presentation of major classes of operating cash receipts, such as cash received from customers, less the major classes of operating cash disbursement, such as cash paid to merchandise, is best described as the direct method. We have already seen direct method. Direct method of calculating net cash provided or used by operating activities. What we do in direct method, this is the definition of direct method itself. The presentation of major classes of operating cash receipts at one side, such as receipts from customers, less major classes of operating cash disbursements, such as cash paid to merchandise. This means cash inflows minus cash outflows is best described as the direct method. of calculating net cash provided or used by operating activities. Next. Which one of the following would result in a decrease to cash flow in the indirect method of preparing the statement of cash flow? Amortization expenses added to the statement of cash flows. Proceed from the issuance of this is operating. Proceed from the issuance of common stock is added to the financing. This is financing inflow. Decrease in inventories is operating inflow. Decrease in inventories means we have sold some inventory, so that's why the inventory has decreased. If the inventory is decreasing, we are getting some cash, that's why it is operating inflow. Decrease in income tax payable. Decrease in income tax payable is operating outflow, it's not inflow, so that's why this is the correct option, which results in decrease in cash flow. Next, the information reported in the statement of cash flow should help investors, creditors, and others to assess all of the following. Except this. This is the what we can say the benefit of balance sheet. What are the benefits of balance sheet? We can understand what are the benefits. What is the benefit of cash flow statement? Cash flow statement. Benefits of cash flow statement. What are the benefits of cash flow statements? Company's ability to pay dividends and meet obligations. Yes, this is one of the benefit of balance sheet, that you can assess the company's ability that it will pay dividends on time or not, to meet obligation. Yes. Company's ability to generate future cash flows. Yes, you can assess the company's ability to generate future cash flows. Cash and non-cash investing and financing transactions during the period. We have seen that there are non-cash investing and financing transactions during the period that are reported on the statement of cash flow. But management with respect to the efficient and profitable use of firm's resources, this is unrelated to the statement of cash flows, it is related to the income statement. So the benefit of cash flow statement is that it will help the companies to find out that the company is able to pay the dividend or it is able to meet the obligation or not. Company's ability to generate future cash flows, and also cash and non-cash investing and financing transactions during the period. Next, Dairy Mitchell Bailey Company's controller is gathering data for the statement of cash flows for the most recent year end. Mitchell is planning to use the indirect method to prepare. Indirect method is being used to prepare this statement and has made the following list of cash inflows for the period. In net income, in indirect method we start with the net income. Securities purchase for investment purpose with original cost. Security purchase, that is investing outflow. Sold for 125,000, that is investing inflow. Proceed from the issuance of additional company's stock totaling $10,000. Proceed from the issuance of additional company stock totaling 10,000. This is financing inflow. So this one is investing outflow, and this one is financing inflow. And they are asking for net cash provided by operating activities. So net cash provided by operating activities is 100,000. Next, during the year, Deltec Inc. acquired a long-term productive asset for 5,000. If you are acquiring a long-term productive asset for $5,000, that is investing outflow. And also borrowed 10,000 from a local bank. If you are borrowing 10,000 from a local bank, that is financing inflow. These transactions should be reported on Deltec's statement of cash flows as what? Outflows from investing activities. Outflow is 5,000. Outflows for investing activities Inflows from financing activities, that is 10,000, which A is the correct option. Next. Atwater's company has recorded the following payment for the current period. Purchase of Trillium stock is investing outflow. Why it is investing outflow? Because you are at Atwater's company and you are purchasing Trillium stock. So you are doing investment in some another company. That is why it is investing outflow. Dividends paid to Atwater's shareholders. Dividend paid is financing outflow. Repurchase of Atwater's treasury stock is financing outflow because you are purchasing your own stock and this is the treasury stock. The amount to be shown on the investing section of the Atwater's cash flow statement should. The amount to be shown investing 300,000. Next. Carla's company has the following payments recorded for the current period. Dividends paid, interest paid, purchase of equipment. So dividends paid is financing outflow. Interest paid on bank loan is operating outflow. Purchase of equipment is investing outflow. So let us find what they are asking for. The total amount of the above items to be shown on the operating section of the Carlan's cash flow statement should be operating section of the Carlan's cash flow statement. Operating section, interest paid 250,000. One is financing, one is investing, one is operating. Next. Baba's company has recorded the following payments for the current period. They have recorded the following payments. Interest paid on bank loan is operating outflow. Dividends paid is financing outflow. Repurchase of Baba's company stock, that is financing outflow. The amount to be shown in the financing activities section of the Baba's cash flow statement. Baba's cash flow statement should be. The amount to be shown in the financing activities section of the Baba's cash flow statement. They are asking financing activities, and we have two activities. One is dividend paid and repurchase of Baba's company stock. So 200 plus 400 gives you 600, which is 600. Selected financial information for Christina company for the year just ended is shown below. We have net income, we have what they are asking for. Christina's cash flows from financing activities. So they are asking cash flow from financing activities. So net income is operating inflow. Increase in accounts receivable. Increase in accounts receivable is operating outflow. Decrease in inventory. Decrease in inventory is operating inflow. Increase in accounts payable is operating inflow. Depreciation expense is operating inflow. It's a non-cash item and it's added to the net income, non-cash item. Depreciation expense is not non-cash item and it is added to the net income. Cash received from issuance of common stock is financing inflow. Cash paid for dividend, that is financing outflow. Cash paid for the acquisition of land. Cash paid for the acquisition of land is investing outflow. So they are asking for financing activities, and two activities we have in financing activities, that is cash received from the issuance of common stock. So we have received from some cash by issuing common stocks, that is financing outflow, and financing inflow. It's financing inflow, and cash paid for dividend, that is financing outflow. So net these two. 800 minus 80 gives you 720. Next. An accountant with NASGO Enterprises Inc. has gathered the following information in order to prepare the statement of cash flows for the current year. Net income Net income is 456,900, includes a deduction of 45,600 for depreciation expense. The company issued 300,000 dividends for this year. So the company issued 3,000. Okay, the company issued 300,000 of dividends this year. So the company issued 300,000 dividends, 300,000 of dividends this year. This is financing outflow. Purchased one new building of 275,000. This is investing outflow. Now we have certain items that are given below. We have accounts receivable, accounts payable, and we have inventory, prior year and the current year. Account receivable, accounts payable, and inventory. Account receivable from 56,860 to 45,300. So account receivable has decreased. And what is the decrease? The decrease is 11,560. Accounts payable has decreased from 12,900 to 10,745. So what's the number? The decreased number is 2,155. The inventory from 186,700, it has increased from 186,700 to 194,320. That is 7,000. It has increased by 7,620. So using the indirect method, what is the amount of cash provided by operating activities? So cash provided using the indirect method, they are asking cash provided by operating activities. We start with net income, and the net income is given as 456,900 plus depreciation expense, which is 45,600, because depreciation expense is a non-cash item and that is added back to the net income, that is 45,600. And we have certain, because this is the financing, this 300,000 is financing outflow, this is 275,000 is the investing outflow. So they are asking for operating activities, so this will not be reported in the operating section of the balance sheet. So we have account receivable. Account receivable has decreased. If the account receivable is decreasing, we are going to add it 11,560. Accounts payable has decreased. Accounts payable has decreased from 12,900 to 10,745. Decrease means you have paid certain amount. So that represents that you have paid 2,155. That is the outflow. Inventory has increased. The inventory has increased by 7,620. This means you have purchased inventory. So that's why this is the outflow, 7,620. So by netting these all amounts, you will get a number of 504,285, which is 504,285, which is C. Next. For the fiscal year just ended, Doran Electronics had the following results. We have net income 920,000, depreciation expense, what they are asking for, from operating activities, net cash flow from operating activities. So we start with net income. Depreciation expense is added back to the net income. Increase in accounts payable is added back to the net income. Increase in accounts receivable, that is deducted from the net income. Increase in deferred tax liability, that is added to the net income. So by adjusting this number, you get a number of 1,018,000. That is 1,081,000. Next. 3 years ago, James Company purchased a stock in Zebra Inc. James Company is purchasing a stock in Zebra Inc. That's the investment at a cost of 100,000. This stock was sold for 150,000 during the current year. This is past, this is not reported. And the stock was sold for 150,000 during the current fiscal year. The result of this transaction should be shown In the investing activities section of the GM's statement of cash flows as 150,000. Next, Median Corporation's controller has gathered the following information as a basis for preparing the statement of cash flows. Net income from the current year was the net income for the current year was 82,000. During the year, old equipment with a cost of 60,000 and net carrying value of 53,000 was sold for cash at a gain of 10,000. New equipment was purchased for 100,000. Shown below are selected closing balances for the last year and for the current year. So what they are asking for, Maiden's cash inflow from operating activities. So we need to find cash inflow from operating activities. So here what happens, there is some transaction related to the fixed asset from here till here. New equipment, we are buying a new equipment of 100,000 and we are selling a equipment, old equipment with cost of 60,000, net carrying value of 53,000 was sold for cash at a gain of 10,000. And we have equipment, here we have equipment 360,000, 400,000 and accumulated depreciation. If a question is being asked like these, you are purchasing some equipment, you are selling some equipment, and some equipment has been given and accumulated depreciation is given, so you need to find the depreciation expense. So let us find the depreciation expense. So in this we will use the net book value method. So equipment at net book value method. So the equipment at net book value method is, we'll take net book value. Net book value means the asset minus accumulated depreciation. So here we have 360,000 minus 70,000 will give you the net book value last year, and 400,000 minus 80,000, this will give you the current year. So the current year net book value is 300. The carried down balance at net book value. This is net book value because we are using net book value. So 400,000 minus 83,000, which gives you the amount is 317,000. Now, brought down balance at net book value is 360 minus 70, which comes to 290. That is net book value, 290,000. We have purchased certain equipment. We have purchased some new equipment acquisition or purchase. So purchase will increase our equipment account by 100,000 because we are purchasing certain equipment that is of 100,000. We are disposing certain equipment. Old equipment is disposed. The cost was 60,000 and net carrying value is 53,000. So an asset that is of 60,000, we are disposing that asset. So net carrying value of that asset is 53,000. So we are using the net book value method. That's why we will use the net book value method, disposal. So disposal is 53,000. We have disposed an asset. So this will give you depreciation expense. So the depreciation expense comes to be 20,000. Now let us find the cash inflow from operating activities. Finding depreciation expense was a difficult task here. So depreciation expense can be found out by net book value method, the way it is done here. So let us start now to find the cash inflow from operating activities. So cash inflow from operating activities can be found out by starting with the net income. So the net income is given to be is 82,000 plus depreciation expense is added back to the net income, and the depreciation expense is 20,000, and we have certain gain is deducted from the net income while reaching the operating activities of the current year. So the gain is deducted. The gain 10,000 will be deducted, and now we have certain adjustments. We have AR. AR from 43,000 to 37,000. This means the AR has decreased. Last year it was 43,000 and the current year it is 37,000. So it is decreased by 6,000. If the account receivable is decreasing by 6,000, that is an addition to the net income. That is 6,000. Inventories have increased 93,000 to 105,000. This means you have bought some inventory, that is 12,000. Cash you have paid for the buying of inventory, so cash is going out. So cash is going out in terms of inventory. So that is deducted from your net income to achieve or to come at the operating activities of the statement of cash flows. Now accounts payable, we have done with the equipment, we have done with accumulated depreciation. Account receivable is done. Now accounts payable. Accounts payable has decreased. So accounts payable has decreased by 3,000 from 22,000 to 90,000. It has decreased by 3,000. So when accounts payable decreases, that will act as a deduction from the net income. So by solving the equation, you will get an amount of 83,000, and 83,000 is the correct option. Next, there are two questions related to integrated reporting. 34 and 35, it relates to integrated reporting. No. A leading manufacturer of electric vehicles has accumulated customer driving interaction data through its unique pilot driver assist program. The data will be used to further develop more advanced autonomous features that the company plans to implement in the near future on its most popular model. In integrated reporting, the system used to accumulate and analyze the driving data is best categorized as. We have 6 capitals. We have 6 capitals in integrated reporting. The 6th capital can be remembered by a mnemonic called Fishman. Fishman. The 6th capital of integrated reporting is Fishman. F stands for financial capital. I stands for intellectual capital. S stands for social and relationship capital. H stands for human capital. M stands for manufacture capital, and N stands for natural capital. The 6th capital of integrated reporting can be remembered as Fishman. So let us see what are these 6 capitals. Financial capital is the monetary resource owned or controlled by the company. The examples are revenues, profits, investments, and cash reserves. Intellectual capital, intangible assets that contribute to innovation. So here we are talking about something innovation that relates to your intellectual capital. That is patents, copyrights, software, something like these. Social and relationship capital. The example of social and relationship capital is customer relationship, brand, reputation, like these. External relationship that contribute to value. Human capital. What is human capital? Human capital is skills, knowledge, expertise, employee skills, loyalties, capabilities. Manufactured capital is the physical assets created or acquired by the company. These are the physical assets. The example of manufactured capital is buildings, equipment, and infrastructure. Natural capital. Natural capital is the environmental resources used or impacted by the company. So the natural capital is like air, water, land, biodiversity, energy consumption. So here they are talking about intellectual capital. A leading manufacturer of electric vehicles has accumulated customers driving interaction data through its unique pilot driver assist program. This data will be used further to develop more advanced and autonomous features that the company plans to implement in the near future on its most popular model. In the integrated reporting, the system used to accumulate and analyze the driving data is best categorized as intellectual capital. We have examples here, we have definition, and these capitals of integrated reporting can be remembered through a mnemonic called Fishman. F stands for financial capital, I stands for intellectual capital, S stands for social and relationship capital, H stands for human capital, M stands for manufactured capital, N stands for natural capital. That is Fishman, my brother. Next. Which one of the following statements regarding integrated reporting is correct? It only contains financial information. No. Integrated reporting contains financial information as well as non-financial information. It only focuses on the creation of value over the long term. No. It focuses on the creation of value over the short term, medium term, and long term. It must be included as a prominent and accessible part of another report. There are two ways through which the integrated reporting is reported. Two ways. The first way is the first way can be a single stand-alone report, and the second can be embedded. The report can be embedded in conventional financial report. So that's why this is the incorrect option. There are two ways to report integrated reporting. It can be a single stand-alone report, or it can be embedded in conventional financial reports. So now the correct option is that it should include material matters both positive and negative. Yes, integrated reporting should include material matters that is both positive and negative.